Are you aware of how the passive income tax rule in Canada is affecting you as an incorporated business owner? If not, keep watching. Hi, I'm Dave and welcome to the Ocean 6 channel. If you're a Canadian business owner making $500,000 or less in active income, you're eligible for what's known as a small business deduction. What's a small business deduction? Well, if you own a Canadian-controlled private corporation in British Columbia, it means you'll pay 11% tax on your first $500,000 of active income and 27% on everything over $500,000. This means you get a reduced tax rate on $500,000 of your active income. Keep in mind the tax rates vary by province. Now, this is where the passive income rule comes into play. If you're making over $50,000 a year in passive income, for example, rental or investment income, the passive income rule impacts how much of your active income qualifies for the small business deduction. Now try to follow along. This gets kind of tricky. For every dollar over $50,000 earned in passive income per year, you lose $5 of your small business deduction. For example, if you earned $90,000 in passive income this year, the first $50,000 will not affect your small business deduction. However, for every dollar exceeding $50,000, you will lose 5 times that amount on your small business deduction. In this example, 5 times $40,000 is $200,000, which is the amount taken off of your small business deduction. Now, only $300,000 would qualify for the small business deduction, as opposed to the full $500,000. This means you would pay 11% tax on the first $300,000 and 27% tax on the rest. In this scenario, the $40,000 in passive income you earned over the $50,000 threshold would end up costing you another $32,000 in taxes. Another way to look at it is your $40,000 is being taxed at 80%. Understanding how your active and passive income will affect how much tax you pay is complicated, so there's a simple tax tool calculator below. Now that you're aware of how the passive income tax rule can affect your active business income and increase taxes, let's talk about 2 strategies to lower your taxes. Number 1, invest in capital gains producing vehicles such as stocks, real estate, or corporate class funds. 50% of capital gains can be drawn out tax-free using your capital dividend account, meaning only half of the capital gain is taxed. For example, if you had a $100,000 capital gain this year from selling stocks, half of that gain could be paid out tax-free using your capital dividend account. Now you're left with $50,000 in passive income, keeping you under the passive income tax threshold. Number 2, invest in a corporately owned exempt whole life insurance policy and benefit from the tax-deferred growth. The growth of the policy does not impact your small business deduction. It's important to understand the passive income tax rule before making any investment decisions. If you're interested in learning more about the innovative strategies to make the most of your corporation and get ahead, book a call. We'd love to chat. Thank you.